Hello, everyone. Good afternoon, and welcome to today's webinar, Innovative Programs for California Property Investors, presented by the California Association of Mortgage Professionals. LendSure, of course, is a proud platinum sponsor of the California Association of Mortgage Professionals, and we look forward to our continued work with this great organization. As questions come up during the webinar, we want this to be as engaging, as informative as possible. Go ahead and use the questions tool, and we'll ask the webinar speakers the questions on your behalf. We'll also have a little bit of time after the webinar to answer any additional questions. So with that, I am going to go and turn it over to today's speakers. Take it away, Tanner.
Hey guys, I'm Tanner Williams. I'm a regional manager here at LendSure Mortgage and excited to talk to you today.
Great. Janice?
Hi, I'm Janice and I'm an account executive at LendSure. I'm looking forward to really teaching you what we can do and how we can help you close more loans or get your LOs to use our wonderful products.
Great. Nicole?
Hi everyone, my name is Nicole Truppi. I'm a regional operations manager here at LendSure. Been with the company a little over 3 years, have seen a lot of different scenarios, and I'm excited to share those with you today.
Awesome.
So for today's agenda, we'll start off talking about DSCR. That's synonymous with investors, very, very popular program nowadays. We'll talk about financing. We do offer up to 10 units. Now that's residential units, right? We aren't going to do anything like office space, but 10 doors residential. Our fix and flip program, and then with that, some ground up construction type stuff. Talk about self-employed borrowers, our bank statement loan, which is very, very common for those that are self-employed and big into the investment space. We'll talk about foreign nationals, what we do for those that want to buy investment properties in the US but don't necessarily live in the US. Some unique things we do as far as calculating DTI on investments. And then reverse 1031 exchanges, which is a pretty deep rabbit hole, but we'll just kind of scratch the surface of it and explain to you guys what we do in that arena. So a little background on us. We were founded in 2015. That said, we do have a highly experienced management team. So a lot of our senior management group goes back to accredited, back before 2008. If you did any business with accredited back in the day, very large, publicly traded subprime company. Nowadays, subprime isn't really around anymore, right? It's non-QM, and we'll get into that a little bit as far as what our typical borrower looks like. But you're working with a very, very experienced management team and company in that regard. We're lending in all 50 states. New York is the one exception where we can't do owner-occupied. We can only do investments. But we're able to help out on loans pretty much anywhere in the country.
Oops, sorry.
Well,
so,
oh, sorry.
No, you're good, Janice. Yeah, what I just mentioned, right? Talking about the, what's our typical borrower look like, right? So it really is your A paper borrowers. It really is, those highly qualified, just barely miss A paper, right? Don't quite fit a guideline here or there type of borrowers. So we don't do anything Fannie, Freddie, FHA, or VA, but there's a lot of these borrowers that can qualify for those kinds of loans, right? Can qualify for a Fannie, Freddie loan, but choose to go non-QM instead for a variety of reasons. We'll talk about a lot of those, but it's pretty, I would say, new that that kind of happens, right? In years past, it's like, well, if you can go conforming, it's just better. And that's not necessarily the case anymore.
Awesome. Before we go on, I'd like to introduce Dale DeGennaro. He is the president of CAMP. Dale, would you like to say hello to everybody? I see that you're muted. Dale, it looks like you're muted. Let's see, the mute button is right above your little camera icon.
There we go. Sorry about that.
That's okay.
Happy Hump Day to everyone. Thank you for joining the webinar today. We really appreciate it. I've always found that it's very rewarding to help my clients get into the investment world of real estate. Really helps them get ahead and helps your bottom line as well. So we love this kind of topic and all the various different things that you can do these days. Also, just a quick reminder about a few things going on at camp. So we have our spring camp that's coming up. That'll be our technology and legislative conference. That is May 6th and 7th, and that is at the DoubleTree in Sacramento. That's 2001 Point West Way in Sacramento. So the first day will be expo speakers on technology, all focused around different technical aspects, some speakers on AI, kind of getting ahead of the tech game. And then the second day will be our typical legislative update and visiting the Capitol and meeting with the various different regulators and legislators throughout the afternoon. And it's critically important, I think, these days for us to be involved at that state level because, as you know, the CFPB may be winding down, and there's been some correspondence with the state that they need to pick up, where the CFPB is leaving off. So keep that in mind going forward. Next week, we have a Freddie Mac webinar on Wednesday, the 26th at 1 p.m. And that is deconstructing a generation. It's all about millennials with Monica LaCrue. They're the largest home buying group. And so she's going to provide some amazing insights into that market share and gaining more of that market share. We'll have some additional LendSure webinars coming up. Next one should be Wednesday, March 19th at 1. And then former past president of the association, Fred Arnold, will be doing a webinar on sales and marketing. That'll be March 26th at 1 p.m. So don't miss that. That'll be a lot of fun. And just a reminder, we do have, if you get 3, your membership is free. So if you bring in 3 new members, your membership will be free for the next year. You'll also be entered into a couple of different drawings, and there will be a raffle for a all expense paid vacation trip to Puerto Vallarta. And with that, if you guys don't have any questions for me at all, I'll turn it back over to you. Thanks so much.
Thank you, Dale. Janice.
Wow, that's exciting, Puerto Vallarta. Well, if you want extra vacation money, one of the best type of borrowers to have is investors, right? Because the growth of investor property, they're the kind of, and it's in the next slide, but I love to say it, investors are the kind of borrower that keeps on coming back, right? So there's a lot of growth potential in that. But anyway, the buyer market is young, and there's also people who aren't able to finance. I think this one's more about condos, isn't it? We're looking into the buyer's market. There's not enough single detached homes to buy, so you're going to have a lot of people looking to rent. So your investors are going to be able to buy properties. It could be a condo, non-warrantable condo, things of that nature, using a lot of our different tools for our investors, right? So a lot of millennials do prefer to rent, and they want to be in an urban neighborhood and, can walk to a bar, walk to the store. And so you're going to have a lot of people who are looking to rent. So you're going to need investors who are going to own those properties to rent those out. So it's a great opportunity. And I'm going to teach you a little bit about our program. So this is the slide I was talking about. And property investors don't stop with one property. They keep coming back, right? So if you give them the best experience possible, it's a no-brainer. They're not going to shop you around. They're going to go back to you. So at LendSure, we do our best to have a really clean pre-approval process up front so that you don't have issues down the line, right? And so as they build their portfolio, they're just going to be coming back to you. One really good news is we don't have a cap on the number of properties that they already have financed. So if they're already a seasoned investor, that's not a problem. Tanner was talking about that, like why would somebody go non-QM? Well, one of the reasons would be even if they do qualify full doc, maybe they already have a bunch of properties financed and they're not allowed to buy another one conventionally. But anyway, without further ado, Nicole's going to go over borrower profiles of different types of investors.
Yeah, so investors come in all shapes and sizes, just like the different properties do as well. But for specific borrower profiles for our investor, fix and flippers, we're definitely going to get into that. First-time investors, we do allow first-time investors on our investment products. Some lenders do not, so that is good to know. Typically max at a 75% LTV, but we do absolutely entertain first-time investors. When we talk about mailbox money investors, that is a little bit of an older phrase. Back in the day before Zelle payments and direct deposit, these investors truly just had investment properties and they would walk to their mailbox, pick up their checks, and that was their income. So basically, when we say mailbox money investors, we mean people who truly just invest in real estate for a living. Again, going to Janice and Tanner's point, where they don't stop at one loan for you. When we talk about college investors, a lot of times we see investment property purchases in towns that have a lot of college student presence, because we have done different programs where we're qualifying not only per the unit, but understanding that we're in a college town, and we will actually do a per room rental at that point, especially if they're purchasing from another investor that had that history already. We do allow our foreign national borrowers in our investment programs, again, on purchases up to 75% LTV. And something that's definitely different than conventional, we allow borrowers to keep their primary residence, their current primary residence, and give them credit for income on that rent, on that property, turning it into an investment rental property when they're trying to purchase a new primary residence. So we do allow to retain a current primary, utilize rental income for that property to qualify for a new primary purchase. And then again, those savvy borrowers who are looking to switch out of certain investment properties, and they do what's called a 1031 exchange. Again, usually a very savvy investor. And like Tanner mentioned, we also even offer reverse 1031 exchanges. All right, so really breaking down the investor loan options. So kind of typical goes along with conventional would be our full doc. So full doc would be our tax returns, possibly W-2 and pay stub borrowers, very typical in the calculations for the income. If we are doing investor income qualified, we can use our bank statement product to qualify income. We have the option of either 12-month or 24 months for the bank statements. Our favorite, I think, investment product is the DSCR. So that's the third column there, the debt service coverage ratio.
Why is it our favorite?
Because the amount of documents that we don't have to get for this is wonderful, and it provides even better customer service. And if you're familiar with FHA, we want those multi-units to perform on their own. Same thing with the debt service coverage ratio or the DSCR product. As long as the rental income qualifies and covers the PITIA, we don't actually need income documents at all. So that would be the DSCR. And then the fix and flip for our investor borrowers, that is when you're rehabbing an existing property, and we do have that availability as well.
Nicole, I've got a question. What are the property types that are allowed under the DSCR program?
So what is really great about the DSCR program is we just keep growing it. So as typically we see single family homes, 1 to 4 unit homes. We do allow condo-tels in the DSCR program. We allow regular warrantable condos. We allow non-warrantable condos. And one of our other favorite products, we do also have a DSCR for a 5 to 10 unit residential property. So we are pretty all-encompassing in the DSCR program.
Well, thank you.
And Janice had touched upon some of this, no cap on the number of properties financed. So really think about that. When you have a savvy investor that owns, say, 15 properties, each property has their own LLC, their own tax return. It funnels into their personal tax returns, maybe another business. You kind of get those skittish borrowers who think, I don't want to submit 15 plus tax returns to you. I just want to keep on purchasing investment properties. Well, with this, we have no cap on the amount of properties that we can finance. So whether we're purchasing or we can refinance existing portfolios, and you can rest assured that they wouldn't necessarily have to give us income documents as long as those properties perform. So we do have 10 loans for any one investor. We do go over that. That is a kind of an industry standard there. If we are using income documents, we will allow DTIs up to 50%. Again, we went into some of the actual collateral that we'll use, which includes the non-warrantable condos. If you have a rate-sensitive borrower, we do allow rate buy-downs there as well. Aggressive and always growing DSCR program. And again, we do use the bank statements, DSCR for investment properties, and one even further, we do allow an interest-only option as well, and that is to qualify on investment loans.
Okay. And Nicole, I've got a question. Do you cover towers? That is a unit in a 19-unit tower.
That would be a specific scenario. Definitely reach out to your account executive. I know that we have seen the scenarios before, and depending on the LTV we're requesting, the strength of the borrower, we may consider it.
Okay, great. And how does the rate down buy down feature work? Janice, you want to take that one?
Absolutely. I'm glad that somebody asked this. So we have a wonderful thing that we call stacking. So we can finance a buy down, which means the borrower doesn't have to pay that out of pocket. It will depend on your LTV and the program type, but essentially if you were at 70 LTV on a DSCR loan, you could finance your broker compensation and a partial buy down to get them a lower rate, and you don't have to increase the rate to get paid. It's very, very cool. We call it stacking, or I call it rate cutter. Depending on your rate and how low you're going, it's either 2-to-1 or 3-to-1 cost. Meaning, if you want to buy it down by 0.5%, it would cost a point or more if you were buying it down more. But you should check with your account executive, but it's very, very cool. And this is very unique to LendSure. The stacking capability is amazing. Borrowers are happy they don't have to bring as much cash to close.
And Janice will enter into DSCR.
Oh, well, that was convenient. Okay, well, DSCR, Nicole really touched upon this. You don't need mortgage ratings on all other properties. You don't need to verify tax returns. This is why it's one of our favorites, because investors love it. Just the sheer idea of qualifying someone with a lot of properties already and full doc and having to get so many documentation, it's overwhelming for a borrower. But it might be a first-time investor DSCR. And they maybe have very complicated income, or on paper just doesn't really show up. But if the house can afford itself, that's how I like to see it. If it pays for itself, they qualify, right? We can check their FICO, assets, and that's all you send in: application, credit, and assets. And then we get to work. And we have a lot of different niches within our DSCR program. Ratios under 1 are allowed, depending on the credit score and how low. No ratio, depending on the down payment. So there's layers to this, and we can apply it to a condotel, to non-warrantable, to foreign national. The possibilities are really great with this. So just think about that. It's easy.
I have a question. How do you qualify for a no ratio?
Very good question. So a no ratio does require 35% down. Off the top of my head, I think the credit score is 680 or 700. I could check guidelines. I haven't done a no ratio in a while, but that's pretty much how it works. And the rate is a little higher, right, because it's higher risk. But there's also 0.75 ratio, which is 75 LTV. And think about this. I think Nicole had mentioned interest-only loans. If you make it an interest only, you might actually cash flow, and then you don't have to have that higher rate. And then the borrower's happy because their property is cash flow positive. So a lot of solutions there. Oh, well, I've had this question a lot. How do you calculate a DSCR ratio? So it's the rents, either from the 1007, the gross rents, divided by your principal, interest, taxes, insurance, and association if applicable. And that's when you're going to know if it cash flows or not. Now, if you were doing an interest only loan, you take out that P, no more principal. So that's pretty much how it works. And the requirements are listed kind of below for the standard DSCR programs. The 5 to 10 does require a slightly higher ratio, but typically if you have 5, 6, 7 doors, you're going to have better cash flow.
So these are some of the documents that we will use to qualify for your DSCR, that ratio to do the calculation. Typically on our refinances, we are looking for the copy of the current lease. And on purchases, we're looking at what you have here on the right-hand side is our Form 1007, which gives us a monthly rental figure. So sometimes people will say, well, the tenant that's currently in there is higher than the market rent. We've actually done scenarios where we've been able to document 2 months of that rental receipt, and we've used the higher of the lease amount, the rental or lease amount. All right, and then kind of going into some additional information on the DSCR. Really great. We can go up to 1.5 million for a loan amount, and we have all on this call gotten a higher loan amount approved in our DSCR product. Again, it just depends on the strength of the borrower, where you are. You're going to have higher values and loan amounts in Los Angeles versus other areas. And with that, we do look at minimum FICO of 620. We might have some reduced LTV there, but we will go as low as 620. We do prefer the DSCR to be at least 1, but like Janice mentioned, we do have other options, including a DSCR under 1, no lower than 0.75, or a no DSCR ratio option as well. Qualifying interest only, and then the rental income verification, like I had just mentioned, the 2 documents that we typically use. And then we do have a little matrix at the bottom for you on the single family and the 2 to 4 units, the LTVs that we're typically looking at for rate and term purchases and cash out.
Is that still correct? I think this might be an older slide, because I thought that we went up to a little higher for the purchase. Maybe I'm mistaken.
This is a really good guideline. We can go a little bit higher, and definitely with senior management approval. We do pride ourselves in being an exception-based, and we make common sense lending. So definitely a possibility.
All right, great.
I'll add on to that real quick, just to say that the common sense lending, the exception based, is really, really important. Take DSCR for an example. We actually have quite a few times approved and closed first-time homebuyers on DSCR, and I know that's a pretty common no-go for most of our competitors. So, we have to be comfortable with the occupancy. The story has to make sense. We have to understand what's going on, but to even entertain first-time homebuyers on DSCR is something that is pretty rare.
Great, thank you.
Very true. I think, we've talked about this, but for anyone who's listening and who's interested in a niche product that's not as widely available and actually pretty easy, is our 5 to 10 unit with DSCR. We do go up to 2 million. This does require a slightly higher ratio. It is 1.2 right now on guidelines, but we do go up to 75%. So if you have an investor that is wanting to buy a property that cash flows, 5 to 10 could be really where it's at. It does follow a slightly stricter guidelines, but I've gotten exceptions in the past on those as well. And it really is kind of a great product to call one of your investors up and go, hey, I don't have to get you this commercial loan that's more expensive and harder to do. We have a DSCR product at LendSure that we can, qualify you with. It's a pretty good program. I've closed quite a few.
Cool that.
So to start with some of the different qualifyings in full doc, again, very typical as far as tax returns, W-2s, and pay stubs, but something that really sets us apart when a borrower has additional investment properties and we're qualifying full doc, if the other investment property on the REO or the real estate owned schedule gives us a negative monthly cash flow, we are actually taking that from the borrower's monthly income. We are not adding it to the debts. So on the back side of the debt to income ratio, this often helps our borrowers qualify with lower DTIs. So especially on investment purchases, if for some reason you had to turn anybody down because they didn't qualify conventionally, please reach out to your AE. We would love to see if we have other options for you. All right, so again, this is just a income calculation, just showing the difference here. If we were gonna go conventionally, that's right there in the middle column for the Fannie Mae calculation, whereas LendSure calculation has it a slightly different income, but by taking it from the income, the DTI does end up qualifying there. And there's the difference. So something that was 48 and you may have been getting a refer, we would be able to do a 30% income ratio and we would close that loan very quickly with flying colors.
All right, great. What are rates looking like for the 5+ unit purchase program? Does anybody know off the top of your head?
I have priced out 2 in the past week, and I think one of them I had a 60% LTV, and I believe I was close to 8.25. Another one I had a 65 LTV, and I was closer to 8.5. Both of them very good and experienced investors. But if that is something that they're a little rate sensitive, that is something that you can talk to your account executive. Maybe we can trade it in for some points or see what we can do depending on the scenario.
Great. Tanner, you want to take this one?
Oh, yes, bad. So as far as income qualified investor loans, right? So we've been talking a lot about DSCR, which has no requirement for income documentation. We are able to use income docs, especially powerful when a DSCR ratio would be negative. We can look at pivoting to income so that we don't have to use, quite as high of a rate that would come along with a negative ratio DSCR. So we can do full doc. We can also do alt doc. So any of our, normal programs, bank statements, asset depletion, stuff like that. We'll go up to the 80 LTV. So you were absolutely right, Rose. The 80 is where we'll go even on DSCR. It's just harder to get the cash flow on DSCR. So we see a lot of, full doc or bank statement 80 LTV investment loans. Same thing as Nicole said on loan amounts, technically 2 million, realistically probably go higher, closer to 3, maybe even 3.5. Much reduced LTVs for that. Talking maybe a $6 million home to have something like that. We'll go cash out per guidelines as high as 500,000. I've done upwards of $1 million, same type of thing. We grant a lot of exceptions, right? We hear us say that a lot. Single family 1 to 4. So I did mention earlier we go to 10 units. We'll only do that on DSCR. So for using income, we cap it 4 units. We'll do non-warrantable condos, condotels as well. Talked a little bit about the financing of multiple properties. I actually did 18 for one investor about 1.5 years ago. So we'll even go above the 10 that we say we'll cap at if we like the borrower and like the situation. And then qualifying on the IO payment is huge. So obviously we do this on DSCR where we use the IO payment to calculate what our DSCR ratio is. But even when we're showing income, we use that IO payment for the purposes of figuring out what our DTI is. So it's another way that we can, manipulate those numbers and make sure that a borrower qualifies. And then bank statement loans. So one of the great things about LendSure in our bank statement loans is our flexibility, right? Ties back to the whole exception granting. So, we'll do an upfront evaluation of your income even before you submit a full file. Obviously, we prefer the full file. That's how we grant those exceptions. We very rarely will commit to an exception before we kind of have an idea of what are the strengths and weaknesses of the loan as a whole, not just the income piece. So we like to get full files so that we can be as aggressive as possible on your income, but it doesn't mean that we won't look at income by itself. We don't need a CPA letter or a P&L statement, and I'll add some more context to this. Pretty standard for our competitors to use a 50% expense ratio, and Janice will get into talking about expense ratio more on the next page. But they will let you adjust that expense ratio if you can provide a CPA letter or a P&L. And we are able to adjust that expense ratio without needing either of those documents. So it really helps out for those borrowers that are self-preparing, right, and don't have a CPA. As far as ownership of the business, they only need to own 25%. A lot of competitors will say they need to own at least 50. So that's a place that we'll set ourselves apart. We use multiple banks and multiple bank accounts. So that could be a situation where someone was depositing to Wells Fargo 6 months ago. They switched to using Bank of America. So I got 2 sets of bank statements, but really it's one business, one account. And it'll also apply in situations where I have a business account, but I also deposit all of my checks to my personal account for the business. And so we're able to get copies of some of those checks, see that it's business related, and use both sets of bank statements, the business and the personal, to qualify that person. Expense ratios, I'll leave that to Janice here to talk about in a second. LTVs will go up to 85, in some cases even 90. And then FICOs, we actually go down as low as 640 and then even lower with exception on either 12 or 24 months. For us, 24 months will offer you a little bit better rate, whereas 12 is more standard with what the rest of the industry asks for.
Well, Tanner did touch upon this, but this is very unique, and I always get the wow, you really do go as low as 10% expense ratio. And the answer is yes, we do go as low as 10%. And the reason why is we are a common sense lender. If somebody that works from home, doesn't have employees, doesn't have a cost of goods, right? They're just maybe doing marketing on their computer. Why on earth would we take away, 50% of their income? And this is what really makes LendSure unique. So here's a kind of a breakdown of the business, they fill out a business narrative form. And I always tell my clients, it's kind of a very simple form, but it's such an important one to fill out, with thought and actually caring, because it could make the difference between your borrower qualifying or not. They have to sit down and talk to them and say, what do you do? And it takes 5 minutes, but once you understand that, you can, like this example, do something like a 25% expense ratio. So how do you kind of, gauge their income? Well, if on average you're seeing $10,000 every single month, well, it doesn't necessarily mean they make 10 grand, but they certainly could make maybe 7,500 if maybe their expense ratio we determined ends up being like 25%. Of course, it could be less, it could be more, but those answers are really helpful. And like Tanner mentioned, we don't require a CPA or a profit and loss. All we require is I think it's like 9 questions that you ask, like, do you have employees? Do you pay them? That kind of thing. And then tap into the foreign national market. I don't remember who has this one.
I think this one is Nicole. And I'm sorry, I was going to say that I'm getting a bunch of questions about whether or not they're going to get a copy of the slide deck. Yes, look for an email from me in about an hour after the webinar ends. It's going to have the webinar recording and it's going to have a copy of the slide deck for you.
Great. So moving on to actual borrower types, and this is a foreign national. So a foreign national, a lot of lenders are not offering loans at this time, but we will on second homes and investment properties. So foreign nationals are not US citizens, they're not permanent resident aliens, they are not non-permanent resident aliens or an NPRA, ITIN. They do live and work outside of the US with no plans to relocate to the US permanently. It really is an untapped market, as majority of these borrowers assume that they have to purchase all of their real estate in cash. And a lot of these foreign national borrowers are looking to start a portfolio in the United States. So this is a great piece to let them know that you do have financing options. Not only does it save them capital because they don't have to put all the cash into it, but it also does start to give them US credit. So that is something to consider. And some of the LTVs on a purchase, we will go to 75% loan to value. We do not require a credit score, although we can sometimes obtain them from foreign countries. Canada, Mexico, the UK, very easy to pull some of those credit reports. Equifax does Canada, so we have different ways. But if it is a country that doesn't actually produce a credit report, we are able to obtain 3 trade line letters from their country of origin. So we are flexible with the credit. And we also, if we are going to go income verification, we will accept CPA stated income verification. But even more so, the foreign nationals looking to purchase investment properties, they can go DSCR. So once again, just another set of documents that the borrower doesn't have to provide to you. If we go DSCR on investment properties, the foreign nationals just have to provide assets and those credit trade lines.
Fix and flip.
We have a lot of questions on the fix and flip and also the ground up construction typically. So let's talk about fix and flip first. So our fix and flip is the rehab loans. So we already have an existing property. Maybe it needs to be completely gutted and redone. Maybe it is a 4-unit and they want to convert it into 4 single condos to sell off as individual real estate. We have seen a plethora of different scenarios come across our desk, and we are open to any level of investor experience. That's huge. A lot of lenders, fix and flip is for experienced investors only. We do review them. I would say in hours is true. Jim's team is wonderful. You fill out a questionnaire form and then we get back to you very quickly. No application there right away. No EPOs. We know that the borrower is looking to truly fix and flip the property. They are going to rehab the property and sell it. We don't have to worry about an EPO. That is huge because we know what your intentions are from the beginning. No prepayment penalty. We don't analyze income or use debt to income ratios because we are once again looking for that property to sustain itself. And then if you have the investors who actually want to what we call buy and hold, we still have an option for them to renovate that property. They do have the option to go fix and flip and then with an exit strategy of holding onto that property in a different finance.
Nicole, does that mean that the broker can get 2 loans?
Very probable, very probable, yes.
But you know what, I've talked about this with the fix and flip team. What's really nice is that we've, as LendSure has supervised the flip. They know that the money's been invested into the home to update it, right? So it's easier for us to use the updated value versus purchase price in these cases. We will, you know, look into doing that. So it really helps that person say, yeah, I want to keep this home. It's going to make a great rental property. Well, then you turn around and you get out of that 12-month, you know, loan and get a 30-year fix with a DSCR loan.
Nice.
Program guidelines. So speaking of, we do allow for any level of investor experience. Which is nice. So some fix and flip programs do require that they have other flips under their belt. So we will consider first time fix and flippers. Credit scores go low as 660. Remember, this is just for investors. So this is non-owner occupied. It could be single family and multi-units. Now I know they're capped at the 4 units in the fix and flip world right now. They do go up to 85% of a cost, so that's pretty good, and up to 100% of the rehab budget, which is really awesome. It is a 12 months term and it's interest only payments. And of course, if you're very interested, I refer you to our fix and flip team, the experts.
Yeah, and we can talk a little bit about the loan process, but again, if you have more detailed things, please email me after the webinar or reply to that thing, and I will connect you to our fix and flip team. What are the rates looking like for fix and flips? Does anybody know?
11s, 12s, around there.
All right. And then, Rick, I see your question. I'm going to have the fix and flip team reach out to you to answer that one because I want to make sure that you get as accurate and as complete of information as possible.
So this is the loan process. Like we mentioned, it is pretty, it's a little bit shorter than the standard IRLA, which is really nice. And we do take care of a lot of that in-house. And we were talking about the draw process. So we will actually handle the draws. So when we talk about a draw process, if you haven't done a construction loan before, you have a budget and that is typically it's completed in different phases, you could say. And each phase, once it's completed, you will get a draw for the next phase. So that is something to keep in mind. But what's really nice is we do handle everything here in-house. So you know exactly who to contact to get out there to verify it, who's going to be sending you the money, etc. And the client will be reimbursed a % of the completed work based on the original loan to cost ratio. And again, that's usually already predetermined in the phases and the draw periods.
Nicole, how does the appraisal work for fix and flip loans?
So typically we will get a valuation of what the property is worth currently. We get an understanding of what you're looking to do for the rehab. So is it a full gut rehab? Is it just really remodeling bathrooms and kitchens, which are going to give you the most value? And then from there, we will determine what we anticipate the after value to be. And that's a broad overview of how the fix and flip and construction appraisals and draw work.
I know I'm seeing a ton of detailed questions about fix and flip. I promise I'm going to have the fix and flip team reach out to all of you guys. But in the interim, if you'd like, on our website under broker resources, you're going to see our library of webinars. One of our webinars that we did a couple of months ago is on fix and flip and ground up construction, and it goes into a lot of detail of that program. So just go to lensher.com. Under broker resources, look for mortgage professional webinars to access our entire webinar our entire library of great webinars. Ground up.
So now getting into construction loans that do not have a collateral currently. So we have the option to purchase the land and do the ground up construction in one loan. A lot of the times we have our borrowers who already own land and their ownership in the land is the down payment for the construction. So really great. We are doing this on investment properties right now. We do have a 12-month and an 18-month term option. You know, if you're in warmer climates, you'll probably be able to have construction days more, and you'll have that 12-month term met very easily. If you're in a colder climate, you are at the mercy of the weather. You might need that 18-month. We do the same thing as the fix and flip. We review the project in detail, what that land is worth now, what your cost to build, what that anticipated value of the finished collateral will be. We do 80% of the construction costs. And I do just want to point out here plans and permits. So whether that is the ground up construction or the fix and flip, we are looking to make sure that whatever we are trying to accomplish in the plans and specs are legal wherever the subject is located. And again, income documentation is not needed to qualify. Think of it kind of like a DSCR loan. We don't want income documentation. We want that collateral to sustain itself.
1031 exchange.
All right, so we'll start just with a regular 1031 exchange, pretty basic. I'd imagine that most, if not all of you guys know what this is, but we'll kind of build from here. So 1031 exchange is a tax deferment strategy, right? Enables investors to sell a property. They'll take the proceeds from the sale of that property and reinvest it into the residential or commercial market, you know, by buying a new property, right? And so with a specific carve out in the IRS tax code called Section 1031, you're able to defer the levying of the capital gains tax. So, investors love doing this. It's very, very common. You guys probably already heard of these. So there's a couple of things that come with 1031 exchanges that investors don't love, right? One of those things is going to be, the risk of a failed exchange, right? Where they sell a property, they're intending to do a 1031 exchange, but they only have a limited amount of time to buy the new one. And in that time frame, they either are A, forced to buy something they don't like or for a price they don't like, or B, forced to have the exchange fail and they have to pay the capital gains tax anyway. So, if you ask anybody that's done a 1031 exchange before, like any borrower, they're probably going to tell you the most stressful time is the 45 days they have to identify replacement properties after they've sold their old investment. So that 45-day window is a very big stressor on these types of transactions. So let's flip over here to the next slide. And talk about reverse 1031 exchanges. So this is much more niche. Far fewer people have heard about it. It's essentially the opposite of a regular 1031 exchange. Instead of selling a property and then taking the proceeds and buying, you're actually buying the new property first, and then you have a certain amount of time to sell your existing property. So the buy before you sell concept, it does a couple things for you. One, it very greatly alleviates that stressful time period, right? You shop at your own pace, basically, right? As soon as you find something that you really like, you pounce on it, but you're not trying to find something you like in a tight 45-day window. Once you close on the new purchase, you have 45 days to identify which property you're going to sell, but you already knew which property you wanted to sell. So it's not really a tight time frame at that point, right? It plays really well into swing in the market, right? Pretty much universally, things are appreciating right now. So if you were to sell a property now and buy a new one in 6 months, you're on the losing end versus if you were to buy a property now and sell in 6 months. You also have no gap in your rental income, right? So if I sell first, I go however many months without rental income while I wait for my new purchase to come through and be closed. Versus if I buy first, now I'm actually double cash flowing. I get rent from 2 properties while I'm working on selling that old one. So, with all of those benefits in mind, the question may be, well, why don't more people do reverse 1031s? Why is this such an unheard of, very niche thing? And the answer to that is because financing really isn't available for reverse 1031 transactions, at least until we started doing them. So we're one of a very, very small, subset of lenders that will entertain these types of transactions. A lot of legal mumbo jumbo behind that, and it's a deep rabbit hole, so I won't get into it. But it's just something you guys should be aware of that we can offer that is very, very unique. So this buy before you sell type of concept actually aligns very well with our bridge loan. It's something we really didn't talk about on this call, but it's one of our best programs. We have multiple webinars we've done on this, and your account executive would love to talk to you about our bridge program and how it works. We actually kind of sometimes joke that we are a bridge loan lender that also does non-QM because that's how much we do in bridge loans. So, we do them primarily for owner occupied, but obviously in the context of a reverse 1031 exchange, it would be for non-owner occupied. We're able to tap into the equity essentially of the property that they are intending to sell to give them the down payment they need on the purchase so that they can buy now and then worry about selling later. So that purchase loan can be done with pretty much anything we talked about today, right? DSCR, full doc, bank statements, asset depletion, some combination of those things. So we're very flexible on it. It's something that if you guys have never really thought about or never marketed, never talked about, if you have agents that you're close with, I'd start kind of floating this out there and say, hey, you ever thought about reverse 1031s to your investor clients, and even offering a bridge loan in conjunction with that.
And what makes, Janice, I'm gonna have this one be your last slide. I know that you have an appointment coming up, so I'll have you talk a little bit about LendSure.
Thank you. Well, I do love things that make LendSure different because that's what's going to stand out and really kind of keep this all in mind. We do a full pre-underwrite. So what that really means to me is that the first 2 days when you submit a loan is we're going to get all the hairy stuff out of the way. Why is the loan here? Why do you need a non-conventional lender, right? And it could be many reasons, or it could be one. But whatever that reason is, we fully pre-underwrite your loan, and that's really valuable. And the reason is because it's not going to come down the line later and you go, oh, you know, we can't do that. We're going to get it out of the way at the beginning. And I do value that a lot. And I hear it all the time. They go, wow, you know, we had this loan elsewhere and they told us we could do it. And then at the 9th hour, they couldn't. But you told us in the first 2 days what the issue was and how you were going to overcome it. So pre-approval, solid. We also have a full conditional loan approval, 48 to 72 hours. All the hairy stuff's kind of out of the way already, so that's just kind of like a formality in my eyes. But of course, they do their due diligence as underwriters. But we can close loans fast, especially if you have a fallout deal with an appraisal. We definitely can move rather quickly. We make a lot, and I mean a lot, of common sense exceptions. Our guidelines are there, but we will consider every loan that you bring to us that's a little bit out of our guidelines with compensating factors. And I get a lot of exceptions, and I know Tanner does too. We get exceptions approved all the time. So again, we have a very solid bank statement program for self-employed borrowers. We use our common sense to understand what they do, and that's really valuable. And we have an aggressive approach to DTI calculations when using rental income. And honestly, what Tanner was saying, if you send the package, right, we have the details, and it's a little hard to kind of get it approved, but we can piece it together and ask for an exception. There's usually a loan there for us to close. And it really does make that different. I've been at LendSure for 6 years, and I can tell you that there's not one loan that we haven't like fully considered and looked into with, you know, common sense exceptions. So I'm going to add the last bullet point before I log off. Stacking. You guys cannot forget, finance your points into the loan, finance a buy down, and then your borrower doesn't have to bring as much cash to close. They're going to have a lower payment, and they're going to love you for it. And you know, it really is unique. So that's one thing that does make LendSure unique. And with that, I'm off to a second webinar. I double booked myself, but it was so lovely being here. Thank you so much. And don't forget, call your account executive. Bye.
Bye, Janice. So with that, I want to open it up to any additional questions. Nicole, for the ground up construction, do we do pre-made homes?
At this time, I do not believe we are entertaining pre-made homes. Modular, possibly with the right borrower in the right scenario. But again, it's very easy to do the fix and flip or ground up questionnaire on our website. I would definitely suggest to submit that one in.
Okay. And any other questions? Right now is the time to ask them. Okay, I know that there's a couple that we were going to get back to you on fix and flip. With that, I want to say thank you to today's speakers. I want to say thank you to California Association of Mortgage Professionals for the opportunity to present to you good people. Tanner, any parting words?
I would just tell you guys that your account executives here at LendSure are designed to be consultants, right? So there's all the time, a lot of times that a loan officer will call me and they'll say, hey, I got a scenario, I'm not really sure what to do with it. And I advise them, hey, you know what, this is actually best to go Fannie Freddie. You should make this adjustment. You should wait 2 months. You should do this, do that. And it's going to make a lot more sense for your borrower to go this route. So we want to help you, you know, as non-QM experts, figure out what the best solution is for your client, even if that means the loan doesn't necessarily come to us.
Awesome. Nicole, any parting words?
Yeah, I enjoyed the time with all of you, and I hope that you picked up some tips, tricks, maybe some key phrases, different borrower profiles, etc. And hope that you have a wonderful 2025 and add some non-QM loans to your portfolio.
Thank you, Nicole. Dale, any parting words for our audience?
Just a
quick reminder to join us for spring camp. That's May 6th and 7th in Sacramento. And Freddie Mac will be next week on deconstructing a generation. So that's Wednesday, the 26th at 1. And I would just want to thank, sorry, my phone is ringing at the same time. Just want to thank Lensher for doing a great job and bringing these different programs to everyone in the camp world. It is wonderful to have different options for people to make the American dream come true for them. Thank you so much.
Thank you, everyone. Bye-bye.
Bye.
Ciao.